Hi everyone, you know who it is, Amy Tremaine here with Main Street Properties. I'm so excited for this video today. If you're new to the channel, please like, subscribe, tap that bell to make sure that you get notifications whenever we release new content just like this. If you're looking to move to the Sacramento area, we get calls from people, text, emails every day, just like you, and we love it. In fact, I've lived in Sacramento for most of my life, and so I know a ton about the area. If you are looking to move in 9 days, 90 days, we're here to help. Our contact information is below in the description. So we're going to go ahead and get after it. All right, so we're here with Stacy Medinas. Stacy, can you tell us about your company and a little bit about you?
Yeah, so again, like you said, Stacy Medinas. I am a mortgage broker with Unified Home Loans. I have been in the industry for 38 years. Yes, I used to ride the dinosaurs to work. We didn't have cars then. And fax machines rolled, the fax machine, the paper would roll off of the desk. And we didn't have computers. So I have been doing loans for my entire career and I love it. Yeah, so that's about it.
That's awesome. And your company name?
Unified Home Loans.
Awesome.
Yes.
Okay,
yes.
Great.
And we are a mortgage broker. So there is a difference between banker, broker, and banks.
Okay. Tell us.
Yeah, so let's start with that actually. But I have worked in all different venues. But a broker, I believe, is the best because we have at our disposal 12, 15, 20 different lenders that we can send loans to. And that keeps us the most competitive rates, costs, and obviously I can do any loan on the planet.
I love that. Yeah, I tell all my clients, if you go to a bank and you turn in an application, you're turning in an application to one person.
Yes.
And then they get to decide whether they're going to loan you money or not. But if you go through a mortgage broker like Stacy, yes, then you've got, maybe 20, hundreds of people that are saying, I'll take that loan, yes, which can get you better rates, right? Better fees, better things like that.
It's the best way to go. And over the years, I've made changes for whatever reason, but being a mortgage broker is the best for the consumer, bottom line.
Absolutely. And I'm going to ask a personal question. Sure. What do you think is your number one value in business?
Yeah. So, and I have probably thousands of clients that will say this about me as well. I require of my team and myself to give my clients VIP experience. I call it the Nordstrom experience because customer service to me is so important. And it can be a stressful transaction. It's the biggest transaction most people make. And so for me, the best thing that I do for my clients is give them the best customer service. And I mean like hand-holding. I work 7 days a week, 8 a.m. to 8 p.m. You can catch me on a Sunday. If you have 100 questions and you call me back after I answer a question, I'm not going to be like, ugh, or, put you to voicemail. So customer service to me is everything.
Absolutely. Oh, I agree. Absolutely.
Yeah.
Okay. So let's say somebody comes to you and says, how much can I afford? What's your answer for that?
That is a great question. And your guess is as good as mine. And not to be... And to be sarcastic, but not to be sarcastic, because there's so much that goes into how much you qualify for in a home. And right off the bat, it's how much money are you putting down? What's your mid-credit score? What's your debt to income ratio? There are 4 or 5 markers right off the bat that make it completely impossible to either quote an interest rate or tell you how much you can qualify for.
Yeah, absolutely. I get asked that question quite a bit,
right.
And it's such a loaded question because there's so many factors that go into it. And so what's the best first step if someone's looking to find out how much can I afford?
Absolutely. So what I normally do, most of my business comes from referral sources like you, realtors, past clients. I am 100% referral based after that many years. I would hope that I would be, right? So the first thing that usually happens is I get an intro from someone, whether it's via text or an email or even a phone call. And try to talk to them before I send them something in writing, because I'm trying to get a feel for them, trying to build the rapport with the client, and really figure out what my magic wand needs to be sparking out to make their dreams come true, right? That's the goal. I mean, we're talking about home ownership and it's so personalized. So I like to have a phone call with them first. Okay. And then after that, I will send them an email, give them specific instructions, kind of reiterate what we talked about. And then within the application, there's an apply now link. They click on the link, it takes them to my website where they can complete the loan application. That literally takes 5, maybe 10 minutes at the most, if you're not paying attention, right? And then within the application process, they can upload the supporting documentation we need, such as last 30 days check stubs, tax returns if they're self-employed, last 2 years W-2s or 1099s, last 2 months bank statements, always all pages, please. And then I usually ask for a driver's license, because when we do go to pull credit, I need to know how their name is spelled. And if it gets spelled incorrectly, then we have errors, right? So I always ask for a driver's license.
Yeah, and if they have a name that's like everybody else's, then...
Right, or if they have multiple names. Some people are hyphenated, some people aren't. And that makes a difference in the way that you run credit, because it may pull up some creditors and some not, or we make an error on their credit report and it's not theirs, right?
Ooh, yeah. Right.
So we want to be specific. Yeah. So once that piece is done, once they do their application and they submit their documentation, within 24 hours or less, we're going to know the magical number. How much do I qualify for? And the way that I approach it is, I always ask them, what do you want your payment to be? Because what they qualify for may be much higher than what they want their payment to be. They may qualify for a $700,000 house, but they want a $400,000 payment.
Right. Right.
And so it doesn't really, I give them what's their maximum. And then this is the amount based on what the payment you told me you wanted it to be.
Right. Absolutely. And most people are buying based off of payment. We're not buying based off of the purchase price. We're thinking, what's it going to cost me every month?
And how much can I afford?
Yeah.
Right. And I don't really know how much they can afford, to be totally honest, because all I'm looking at is their credit report. We have so many other expenses outside of a credit report and payments that you're making on debts. So only the borrower knows how much they can afford.
Oh, okay, good. That's really good to know.
Yeah.
Awesome. And then what's the credit score? Like, what's a credit score that someone would need to have in order to get approved?
So credit scores are based on loan program. Okay. So again, this is why it's really important that you have the conversation, and then we run their credit, and then we figure out their particular individual scenario. But I'll give you some generals, okay? So FHA used to be 580. They are now down to 550. Now, let me tell you, the pricing is not pretty at 550 or 580, but normally a loan's going to be temporary anyways, 6 months to a year, maybe 2 years. You're going to suck it up until we can fix your credit, right?
Yeah.
So FHA is down to 550 now. VA is 620 as a general rule, but VA goes by residual income. So there's a whole different calculation. So if their score is 550 or even 500, if they're hitting all the other markers for a VA loan, they still may be able to get a VA loan.
Oh, so that's really good to know. I don't know.
Caveat. Yes. Most people don't know that. USDA is 640, and they are strict on 640. Conventional is 640, but again, the rate and the cost will be rough, right? So on a conventional loan, you'd rather be 680 and above, more like 700 to get kind of the premium pricing. And then a down payment assistance program that usually pairs with an FHA loan, minimum credit score is 640.
Okay.
So you can see how this is, what do I qualify for? How much can I get? Is such a loaded question. There's just no way to answer that question.
Yeah. So they really need to fill out a loan application. Like 100%. That's the only way. You got to fill out
all their documentation. Yes. And get their credit run. Yes.
Yeah. I do get a lot of people that, they're on the fence and they're thinking like, why don't I don't want to run my credit. So can you tell me about that? Like,
yes.
Why do you think people are so scared to run their credit?
Well, maybe because they do have challenged credit, right? And, and they're afraid to look, right? But we have to start somewhere. We need a plan, right? We need to know, where do you stand today? And what do we need to do if there is issues? What needs to be cleaned up? And I can advise them on that. I have people that I send my clients to for credit repair, for example, but we can do a ton on our end to get you to where you need to be, to get to that 550 or 580 to at least get into the house. And then, if you really need credit repair, I'll send you somewhere else. I forgot where I was going with that. I lost it.
Oh, that's okay. I was saying, why don't people want to run their credit?
Got it. Yes. So that's one reason, because they know that their credit's a little, needs a little TLC, right? And they're afraid that if they do have an 800 credit score, that it's going to affect them. So let me clarify this little myth here. So if someone runs your mortgage credit report, there is a difference between a car dealership running it 15 times, applying for 5 different credit cards, or RC Willie to get the 5% discount, right? A mortgage credit report, they made a law, and I can't remember the exact year, but I think it was 2009 or 10 because of the crash in 2008, that within 45 days, it will not affect your score if multiple people run your credit. And the reason that they did that was because they're all about the consumer, and they're protecting the consumer because they want them to shop for the best rate and fees. And what was happening was people were debilitated with fear that it would crash their entire credit score if more than one person ran their credit, right? So, so within a 45-day period, multiple people can run your credit and it will not affect your score. You'll get the one ding from the one initial one. But to really quote you an accurate interest rate and to tell you what you qualify for, we have to run a full mortgage report.
Right.
And we can do a soft pull, but that's only going to give me one score. It gives me all your debt, but it only gives me one score. So if you're out making offers and trying to, I'm eventually going to have to run a full credit report.
Yeah.
That makes sense.
Okay. And then when you talk about the ding that people get on their credit, what is it? What do you see? Because you see their report.
5-10 points.
Yeah, I hear that. I hear people like, I don't want to drop my score 50 points. I'm like, ooh, I don't think I've ever seen that happen.
Only if you just miss 3 car payments in a row is it going to drop 50 points, right? I mean, and if that's the case, we're probably not ready to buy a house right now.
Yeah, absolutely. So, okay, cool. So I think the credit myths are like the biggest myths to debunk, is like, you're going to ruin your credit if you run it for a mortgage. But I think that, mortgage is good debt, and credit bureaus want to see people applying for mortgages.
Absolutely. Yeah. And again, the CFPB, who's the regulator of our industry, is all about the consumer and the protection of the consumer. So that's why they did that law.
I love it. Yeah. So, what if I have collections? What if I have some debt on my record? What does that look like for me?
So negative debt, like collections, is by program again. FHA allows up to $2,000 total in collections that do not have to be paid. But if you have a $5,000 collection, you're going to have to pay it down, minimally negotiate it, right? Which a lot of the times, if you have a collection, you can call them and say, hey, I owe you $5,000. I'll give you $1,000.
Yeah.
Give me a letter that says that it's paid in full and we're good to go. And then I'll do a rapid rescore for them, which forces the bureau to show that it's paid and boosts their score.
Oh,
yeah.
Okay, cool. So it's not like they have to wait the 60 days for it to finally show up.
We're going to force it. We'll force the issue. Now, conventional loans are a little bit less forgiving.
Okay.
But across the board, if you have medical collections, those are overlooked.
Okay.
Which is interesting because they're constantly putting a collection on someone that probably is not accurate.
Well, and obviously we have a medical debt problem in this country. And if we held that against people, it would collapse. I mean, nobody would be able to get anything ever. So
correct. So I want to mention one thing, and I did a video myself on this, about the Cavers system. So Cavers was something that was created back in the 80s.
I have to deal with this.
What's that?
I had to deal with the Caver system.
Yes, right. It's the federal debt naughty list is what I call it. So if you've had any defaulted federal debt, if your student loans are in default or in collection, if you've had, sometimes child support shows up on there. And I'm not sure why it does sometimes and why it doesn't sometimes, don't ask me, but if you're on the Caver's naughty list, you cannot get a government loan until you've gotten that resolved. And a government loan is VA, FHA, USDA.
Okay.
So you can jump to a conventional, but most likely if you have defaulted stuff, your score is probably not high enough to go conventional or have it be worth it. But you're going to have to resolve it. So I tell people, if you're not making your student loans, you're probably not buying a house anytime soon.
Yeah, absolutely.
Yeah.
And so just a little bit of experience from that.
Yes, please.
When I bought my first home, I had a 580 credit score, which was the minimum. That was my minimum score, and we worked to get me there. So
yeah,
when I first got pre-approved, and for anybody that's scared, like I got pre-approved and I wasn't denied. I don't think there's ever like a straight up denial. It's just, this is what you're approved.
Let's get a plan. Yeah, we need a plan.
So I got approved and it was like, like just not enough. And so I worked with my lender, just like you talk about, and they helped me come up with this plan. And I think within 6 months, I had enacted the plan and I was pre-approved again. And I was pre-approved for like $100,000 more. My credit score was better. My interest rate was better. There was just a lot that they helped me out with. So I think it's real, like get the application done, get a plan together, and then you can like do the things you need to do to get there.
Absolutely. And that, I mean, people are afraid because I'm not ready yet. I want to pay down my debt. I'm like, well, don't do that yet.
Yeah.
Let me look at your scenario and see if you even need to do that, because maybe you can use that money towards your down payment or towards closing costs or, the inspections that need to be done. Don't just pay off something because you think it needs to be done. I mean, again, you're the only one that knows what you can afford. But let me analyze it first, and then let me confirm what you're talking about. And there's no harm, no foul. I mean, I do this all day long. I have people, I have closed a transaction with a client I work for 3 years. And, we do this for free until the transaction closes, right? But that's just what we do. I mean, you work with 100 people at once in different stages of wherever they're at, right?
Yeah, absolutely. It's all about the consumer and like getting them to where they want to go. I know I'll be in this business for the next 20 years. So I'm really not worried about when people are going to buy. It's more about, hey, just remember me and let me help you get to that point, Yeah, I'm
doing what's best for them. I mean, that's my whole goal is, what are you trying to accomplish? Let me try to get my magic wand sparking in the right direction, right?
Yeah, absolutely. So I had debt. I had student loan debt. I had tax debt. I had car debt. I had debt, and I was still approved.
Like an adult, adulting.
I still got the house. And then after a few years, I wound up buying what I'm in right now. And then I'm going to fix this place up and buy the next one. And it's kind of just this ongoing thing that you can do to help you build wealth. So I think if you're afraid to run your credit for a mortgage, but you'll let these apartment complexes run your credit every time you have to move, I just like,
I don't get it. Yeah.
Not working. Yeah. Okay, cool. So how much do you think someone should really save for a down payment?
Okay, so again, loaded question, right? Because there's so many different programs. So we'll start backwards.
Okay.
Down payment assistance. Okay, so there are multiple programs out there, and depending on where people are, sometimes there are city grants, things like that. But we'll start with just the regular the one that I love, which is tried and true, which is a Cal Half a Loan. It's a state program, and it actually attaches to an FHA loan. So you have an FHA loan, then you get a second and a third through Cal HAFA. So that particular program right now this is a moving target because of the interest rates, because of what's going on in the economy. They change their programs based on what's happening. They react to it. So right now they're offering the down payment for the FHA loan, which is 3.5%. So that money is given to you as a silent second. It's not a grant. You don't get to have it forever, but you're not making payments, and it just sits there until you refinance or sell the home. Then you'll have to pay it back.
Right.
And then they give partial closing costs. So before they were giving almost all of the closing costs. Now they're only giving about a half of the closing costs.
Okay.
So I'm telling people in the 300 range, you're going to need to come up with probably $5 to $7 grand of your own money. Okay.
Which is not a lot.
Which is not a lot.
Not a lot of money.
And that can be a seller credit.
Yeah.
Because it's technically a closing cost because the down payment's already been taken care of.
Which we do all the time.
Yes.
I would negotiate those all day long. Yeah.
Absolutely. And so what I've been telling clients that are doing down payment assistance is they need to minimally have 1% of the purchase price because they're still going to have an earnest money deposit. They have to do that to execute the contract. You know that piece, right? So if it's a $300,000 purchase price, they need to have at least $3,000.
Yeah, because they've got not just the
ish, right? Because I'm going to credit them back their appraisal fee when they come from people like you. So they'll still have to have that up front, but I'm going to give that back to them in closing costs, but they'll still have inspection fees, right?
Yeah, they'll have inspections, appraisal, deposit. Okay, cool.
Yeah. So we'll start there. We call it DPA, down payment assistance, which is, and there's 1,000 combinations. Let me be real clear, but we'll just start with just the basic.
Yeah.
FHA with a CalHFA second and third. Okay. So then if you just went with a regular FHA loan, the minimum down is 3.5% plus closing costs. Again, you may be able to get the seller to credit partial of the closing costs, but you're going to need at least 3.5% down plus probably another 2% ish, somewhere in that range. Okay. And then the amazing loans, which are the VA, which is for veterans or any military people, and USDA, both of those have 0 down.
Yeah.
But they both have closing costs. So again, you have to figure that out if you have your own closing costs or if you can get a seller credit. Conventional for first-time home buyers, minimum is 3% down. Keep in mind, it has to be a regular single family residence. If it's a manufactured or modular home, that's no counties, that adds, which I get that all the time. You said 3%. I'm like, I said 3% on a single family, not on a different, or a condo. Condos go up as well. So, and then a regular conventional loan, if you're not a first time home buyer, is 5%.
Okay, great. And I've actually, this is getting deep in the weeds, but I've actually had a client use down payment assistance, 3% down for her first home, sold that home, bought a second home, down payment assistance. And I was just blown away. She was conventional, and she worked for the state, but she was a single woman. And it was just really interesting to see that you can take advantage of a down payment assistance program multiple times.
Right. And so that is a good point to make because there are down payment assistance programs that require you to be a first-time home buyer, and there's other programs that do not. So if you use conventional, you don't have to be a first-time home buyer. And by the way, the definition of a first-time home buyer is you have not owned a home in the past 3 years. So if you owned a home 5 years ago and you sold it, or you sold your house, 5 years ago, 4 years ago, you can now be a first-time home buyer again.
Yeah, I think that's
verify that on tax returns, by the way. We see when you've filed the mortgage interest write-off.
Oh,
tax returns. Yes.
Okay, so your tax returns.
Yeah.
This is one thing that I think people they don't think about this, but what you put on your tax returns determines what you'll be able to show as income and write-offs and all these things,
100%.
Tax returns out people all the time for mortgage fraud. And
yes.
It's like, oh my gosh, were you not thinking about what address you put on your tax return?
Right.
That's an important piece. So yeah, pay attention. I've actually had clients, this is something that a lot of people don't think about, but business owners, man, you have to show that you've made some money. And I know it hurts to pay taxes, but that's just the game. That's just part of the game. Like I had a friend and a client who, they're bringing in a lot of money. They could probably buy whatever they want. And yet on taxes, he's an employee of his company and he made less than $50,000. So when we went to get him pre-approved, it was a very low pre-approval.
Yes.
And at that point,
that's why it's critical to be pre-approved.
Yeah.
before you've shown them, 10 houses. Now, can they go look at one or two? Cool. But at some point you have to actually get down to the details of, I'm self-employed. I had a client. Oh God, had a client that was crushing it in her business, and she'd only had it for 3 or 4 years, but they had just done this, right?
Yeah.
So their last year's tax return showed 700,000 gross receipts.
Yeah.
When she was like, we make 700,000 a year. So her realtor was out there showing her $1 million properties, and they're out shopping. $30,000 was the net. 700,000 gross, $30,000 net, dead in the water.
Yeah, that's how this
CPA
went.
is magical. Let me just say.
Yeah. Well, and I'm self-employed, and I'm a single mom with kids. And of course I would love all the tax write-offs. And of course I would love to not pay any taxes whatsoever. But when I looked at my future and what I wanted to achieve with real estate, I realized, it's a drop in the bucket. Like I have to pay this very large tax bill in order to show that I make this money, but I can go out and buy a house.
Correct.
And when you can't, or you have to pay cash,
yes,
it's so cheap to borrow money. Like, why use your cash?
That's right.
So
there's a great balancing act in there. Obviously for self-employed people, LLCs, corporations, things like that, you can shelter your money in there and still show income without paying, the taxes. So there's ways to do it, but I think people are shocked that their net is what we're actually going to use.
Yeah. Well, and it's because we're probably so used to like car dealerships. I think the first lending experience that anyone has in their life is getting a car loan, and
large one. Yes, yeah.
They go by your gross. They're like, show me your bank statement, show me the deposits. Yeah. Tell me you're rich. They don't even care. And so I think that a lot of people have that experience, and even credit cards, they don't check what you actually make when they give you a credit card. But when it comes to a mortgage and what happened with the crash, we got to start taking
forensic. We are literally forensic. We're like forensic CPAs, and everything is so electronic and digital that it's so easy to gain information that they don't even need to send us tax returns. I mean, they sign a form, we send something to the IRS, it comes back in 24 hours and gives us a transcript of everything they've ever done. Right. So I would prefer them just to send the tax returns, so I can actually look at it and have a conversation with them, but we really don't need that. We get a signed form and boom, we're like, yes or no, right?
Oh, absolutely. Okay. So now we've talked about like a lot of different loan types, at least the conforming loans. Right. So which loan should I pick?
It depends.
Well, and also like, can I just pick a loan?
No, because you're going to fit into a box or not. This is why you choose a professional like me who has experience to really look at your scenario. And we're going to get a current plan, the next couple years, 5-year, 10-year plan. Most people don't keep their loans longer than 2 or 3 years because the interest rates fluctuate. They have a baby and they need to move up, or they're retiring and they move down, or they're buying a rental and they need a cash out refi. So there's so many variables that most people don't keep their loans for very long. But you, as discussed, you're going to fit into a box or not.
Yeah.
Right. And so it's really important that you have an advisor, which is what I do all day long. Again, working with clients for years that never buy, but we get them there eventually, is I'm the advisor, and I have to look at your scenario and figure out what's the best thing for you. Now, if you particularly qualify for a conventional loan and an FHA loan, for example, you fit into both boxes just barely. I'll put them side by side and say, this is what I think you should choose because you're payment sensitive and this payment is less. The kicker with FHA is that the mortgage insurance is for life. So you have to refinance out of an FHA loan to get rid of the mortgage insurance. Conventional, so for example, what if someone put down 10 or 15% and they're planning on retiring in that home? They don't have to refinance once they hit that magical number of, I think it's 81% or something. Everyone says it's 20% equity, but it's a little bit more than that. And then they can apply to their servicer to get the mortgage insurance taken away without having to refinance. So it's all of those that information that I need to know what your goals are, and life changes and things change all the time, but what's the plan, and then we choose together what the best program is for you.
Okay, great. Yeah. So getting your sights set on a specific loan can really be like a setup for disappointment.
For sure. Well, and by the way, conventional products, although everyone thinks a conventional loan is better than an FHA loan, the interest rates are higher on a conventional loan.
Oh, yeah. Well, and I think that's like the benefit is you pay the higher interest rate and you get to get your mortgage insurance taken off.
And the mortgage insurance is less, right? So on a conventional loan, the mortgage insurance is less. So it almost evens out. A lot of the times FHA is still beating it out in payment because the rate is so much less, but it's a give and take on that.
Yeah. So it's like,
again, depends. And you need your advisor to be, knowledgeable and active, right? I talk about this all the time in my own videos. When you choose a realtor and you choose a lender, are they actively doing their business? Yeah. Or have they not been doing it and it's just kind of their side hustle, right? Are they full-time loan officers and realtors? Do they know what they're doing? Are they active and up to date on what's happening in your community for realtors or lending, So choose wisely who you choose to represent you, because it's like hiring an attorney, right? Especially realtors. I mean, they're negotiating on your behalf, a legal contract.
They're your fiduciary and they're working with your money. And I'm in an escrow right now with a lender who's not you, which the buyer came with that lender. Right. And the lender has made decisions for the buyer without consulting the buyer.
Wow.
And now we're coming to the end of it and the buyer's having to come up with more money it's just a very odd situation because I don't operate that way.
Right. No.
I'm going to work on my client's behalf, not on what I think is best. So if I think something's best, I'd probably go to them first and say, hey, here's the situation. Here's my solution. This is what I think is the best course of action.
And over communicate. I want everyone to be, they shouldn't have to call me to ask me what's happening, or they shouldn't look at a document and go, what is this? Or what are these numbers? They should have already known. I've had this conversation before it even gets sent to them, because I don't want that call, to be, what do you mean I have to come up with another 5% or whatever, right?
Yeah,
I mean, what if they don't have it? What if they don't have it?
Oh, exactly. And not only that, it's the whole, it's a transparency thing, I think a lot of people look at realtors and lenders, especially after the crash, let's face it, as, charlatans, like people that are here to take their money and sell their home out from underneath them, or get them into a home they can't afford. And it's really unfortunate, but it's real. And I like to look that elephant straight in the eye and address it with all of my clients, is that I know that there are realtors and lenders out there that operate like that, and I've seen it in action, and I choose actively not to operate in that fashion.
And sometimes you lose a client because don't have that hustler mentality. And if they choose not to work with me because I'm not kind of working them up front, then, they're lost.
Yeah, absolutely. But I think we're coming into a time of, I've read a lot of things about buying habits and the psychology behind buying and the psychology behind how we choose who we work with.
Right.
And, the millennials is a very permission-based sales experience. They want to be actively involved, and they want to make the decisions, and they don't want to be bamboozled. And
they're educated. They're savvy. They know what's happening. They've done all the research before they even call you.
Yeah, absolutely. So if you can't speak to what they already know, it's very damaging to the relationship. But 100%. We don't have that problem, do we?
No, it's very rare. And then I think, what did I do wrong? How did I not communicate this?
Okay, so what's really included in a mortgage payment?
Yeah, that's a great question. So principal and interest is the first thing that you always, think of. So the principal piece is the part that pays down the loan balance. And the interest is what you're paying back to whoever lent you the money, the lender, the bank, those hard money lenders. So principal and interest is the first thing. Taxes, which of course go to property taxes. The normal calculation for that is 1.25% of the purchase price. Okay. It's a rough estimate. It gets you a good general idea of what that's going to be. Every single property is different. We do our own little calculation, but that's a good rough estimate. And then we have homeowners insurance. Anybody that's been active in California, lending or realtors know, we're having a major fire insurance issue right now. So insurance is very critical, especially if you're looking at homes in the hills anywhere, because we have something called California Fair Plan, and then you have to have fire insurance as well. Sometimes that equals what your taxes are, which is unbelievable amount. So that's something I watch for with my clients who are making offers. I'm like, what's the property address?
Yeah.
Get an insurance quote for them. So we make sure that we're accurate on our estimate of the payment. And then you have mortgage insurance if you put less than 20% down, or if you don't use a conventional loan. Like I mentioned before, FHA, if you put 20% down on FHA, you still have mortgage insurance.
Right.
Yeah.
And I think a lot of people, they use online mortgage calculators. Which
is incorrect. They're so
rampant, and they are very incorrect. I do have one that's pretty good. You can add all those things.
Yes.
You can check the box for, mortgage insurance and all those things, but it's really so much better to just go to a lender professional like Stacy and say, hey, what would my payment be on this purchase price?
Sorry, trying to turn that off. Yes, absolutely. And then also something that could be added is HOAs. So homeowners association, depending even on a single family property, sometimes we have planned unit developments. And so that is not going to be included in your payment. But when we look at your total qualification for housing, we're going to add that. And that could be $200, $300, $500, $800 a month. I do loans nationwide. Florida, the HOAs there are like $800 a month for condos. $400,000 condo with an $800 HOA. I'm like, whoo.
Oh my gosh, they better be giving me a back massage with that every month. That's crazy.
There better be a doorman with a spa.
That's crazy.
So HOAs are important, and it's not just for condos or townhomes. It could be for single family residents as well.
Okay, great. Okay, so now we know a little bit about what's included in payment. And then what about my interest rate? Like when somebody comes to you and says, what would be my interest rate? What does that, how does that make you feel?
That's a great question. I'm not sure until you apply. That's always my answer. But interest rates are the actual rate that is calculated based on how much you're lending. So when you look at your promissory note, that is the interest rate. Okay. So we'll start with that, because I think people get confused about what an interest rate is and what an APR is, which is an annual percentage rate. Okay. The interest rate is what your payment is calculated on, and APR takes into account your interest rate and all of the cost incurred in the transaction. And then it's an annualized percentage. If you did the calculation by hand, it's like this long.
Yeah.
It's like this, my ball, plus this, minus, blah, 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 right? So interest rate is what you should be very concerned about. Now, if you have an interest rate that's say 7% and your APR is 12, we've got an issue. Because there's a lot of fees being incurred in this transaction. So you want it to be like 7%, maybe 7.5 or something, right? I mean, it should be fairly close. But if they're drastically different, then we probably need to dig a little bit deeper. Okay. And so the interest rate is, the way that we come up with the interest rate is loan to value, meaning how much money are you putting down? What is your credit score? What type of property is it? Because a condo is going to have a different interest rate than a regular single family will. It has what we call a hit against it. It's your rate's a little bit higher on a condo. There's markers that determine what an interest rate is. Are you a first-time home buyer? Sometimes that affects it as well, depending on the program. So there's so much that goes into it. People call me and go, what's the rate? I don't know. I have no idea. Let me, and sometimes I'll just pull up my pricing engine and I'll ask them specific questions. How much are you putting down? What program are you using? What's your credit score? You know, I go through the whole thing and then I can give them a general idea. But also when you quote an interest rate, there could be a cost for that interest rate. Okay. Because for example, if you're buying an investment property, the interest rate is going to be drastically different. Okay. And so when you were talk about paying points, right? Is there a cost for the rate? So when you look at an interest, when we look at a rate sheet, 7% may cost nothing. 7 1/8 may cost a 1/4%. It may cost 1%. It depends on the program and how they're pricing it out that day. Rates change multiple times a day, every single day, no matter what's happening. And so it's important, first of all, to lock in your rate. If you're in contract, just lock it in and be done with it. Put it out of your mind, because what happens is if the rates drastically come down, which they just did this last week, I just negotiated a better rate for a client that is closing on Monday, by the way. They have to re-sign their loan docs, but they went from a 7.99 to a 7.375, and it's saving them $245 a month.
Yes, please.
Right? They were super excited. So that's called a renegotiation.
So if the rate, so what I'm hearing is that if you lock your rate, it doesn't go up, but you can negotiate it back down?
Correct. If it does a dip, if the dip is low enough, right? So there's markers for each loan product. It was very complicated. Let me just, I'm not going to say it was an easy conversation. We're on the phone with the lock desk, with the underwriter, and everybody going, okay. So because there's a lot that goes into an interest rate when you're locking it, because my clients, I credit them almost 0.5% to buy down their rate. Okay. Because I have such high standing with a particular lender, they give me credits. And so that is, it's amazing, but that has to be accounted in that calculation as well. So we were like, but the bottom line, we want the consumer, if the rates improved that much for them, we want them to get the lower rate. Bottom line. So it took us about 3 hours. Let me just tell you.
Okay, great.
Phone calls.
That's really good to know, because I have had clients in the past that say we're not going to lock our rate because we're hoping for rates to go down. Right. And I'm going to say, no, that's insane. Lock the rate.
Yes.
and then renegotiate.
If it does dip significantly, we can renegotiate.
Yeah. But what I've had happen is that they wait and then rates go up, and then they're like,
that's always the case. And never, if you float, it's always going to go up. And then you're waiting like, oh my God, now we have to wait till the last second to watch the rates all day long, every day. It's so stressful. For me, it's like, I need a Tums. Like, lock the rate so we can renegotiate later if it really substantially improves, you know? Yeah.
I think the biggest, just like with any, think about any experience. You want to control the experience, and the more that you leave up to chance, the more you're out of control of that experience, and you're going to wind up having a negative experience. It's just so that's what, for anybody watching, that's what realtors try to do. Realtors and lenders, our real job is controlling your experience. 100%.
And because it's very stressful. For us, for both sides, we're in, we're like the duck on the water, like, but it looks like everything's really cool, but we are not, or a hamster on a wheel, right? We are moving at all times, but we don't want you to be stressed, because you really can't control what's happening in our world. And so we try, that's why I have such a great team. I'm so grateful for I have a production partner who does cradle to grave with every single loan of mine. I want to make sure that it's always a Nordstrom's VIP experience, that they never really see the trauma, right? Because we're traumatized, but they don't know that. And that's okay. That's the way it's supposed to be.
But it's also like, I don't get a lot of pushback, but I have gotten pushback from people that are like, well, I don't want to get pre-approved until I find my home, or I don't want to lock my rate, or I don't want to do this, or I don't want to, and there's a reason that your realtor or your lender, even if you choose not to work with us, please listen to them. There's a reason that we have this. There's a reason I require proof of funds. There's a reason I require pre-approval. There's a reason. And it's not because it's better for me. It's because it's better for the consumer. Absolutely. And I know they're going to have a better experience. So if you're talking with a lender right now, even if it's not with us.
Right.
Listen to them. Whatever they're asking of you, it's to prevent the BS down the road. Otherwise,
Exactly.
you're gonna wind up where you're at, which my client is there. My client is now at the end of this transaction. Her lender wasn't great. And there's BS. There's a bunch of stuff popping up now, and she's not having that great of an experience. And I'm like, ooh, like this probably could have been prevented if you
had you used my team. I mean, we're not getting any advantage to use our own team. When I refer a realtor, it's because I trust them and I know that they're going to do a good job. Same thing with the realtor referring a lender. I've worked with them. I know them personally. I know their ethics and morals and values. I know they're professional. I know they're experienced. And I'm doing this to protect you from yourself. Please use my team. And, when we ask people to use our escrow and title people, we have experience with them. We know them well. Use them because we've seen some catastrophes, right? I'll give you a perfect example of things that aren't going to kill the deal, but if you don't listen to me as a lender, the experience will be bad. For example, when clients get a gift, I tell them, do not let your grandma or mom send the money to you directly. Once we open escrow, I'm going to have them wire the money directly to escrow so that it doesn't muck up your bank statements. Oh, well, they already sent it to me. Well, cool. Guess what? Now I have to analyze your bank statements. You're going to have to give me any deposits that are over and above what you get direct deposited. You'll have to get me a copy of the check, prove where there's a bunch of cash in there. So then we have to back that out. And then now we still need stuff from your grandma or mom. I mean, we tell you to do things specifically in a way because we're experienced and we know, and it's no skin off me. You're the one that's going to have to provide 10 extra pieces of paper if you don't do it the way I tell you to do it. It's not going to kill the deal. It's just going to be annoying and you're going to be annoyed.
I had that exact same scenario, and I always tell them the same thing, like just hold off, don't let them.
We'll tell you when it's time, to do what you need to do.
Let you know. But what we had to go back and ask the grandma or the dad for bank statements and a letter. And they're like, like my family, we're a little country. So they're like, I'm not giving you that information. And I'm like, well, here's the deal. You loaned your baby, you loaned your kid 20 grand. The bank wants to loan them 500 grand. Right. So they want to know where the money comes from. They want
documentation.
Yeah, they don't want you giving mattress money that was done with illegal activities. They don't know you. They don't know that you're trustworthy. So I mean, the more weird money you have coming into your bank account, the more documentation you have to provide, and it just gets so outrageous at times.
It gets very mucky. And in that scenario, had they just wired the funds directly, all they would have needed was a gift letter. That's all they needed. They wouldn't have even needed the bank statement. So you got to follow instructions, but it's not a deal killer. It's just annoying for everyone involved.
A question about rate. Like, should I get a fixed rate or should I get an adjustable rate? What's better?
Well, in my professional opinion, I stick to fixed rates, but there is a scenario so right now with the rates being higher, there's no advantage to get an adjustable rate, except on a jumbo loan. Jumbo loan pricing is very different, and that means it's outside of the conforming loan limits, higher than a high balance, which is set by county. So we look up the loan limits based on the county, and the Bay Area in California is obviously much higher. It's 200,000 or 300,000 more, and so. But an adjustable on a jumbo loan, sometimes the pricing is substantially better. And it's a 5-year or a 7-year or a 10-year fixed. So it's going to be fixed for 5, 7, or 10 years. You're going to get out of it when the rates start to come down, right? And so, but I would say as a general rule, most of society should have a 30-year fixed loan. You can always make higher payments. You can, there's no prepayment penalty on that. But I would say stick with a fixed. It's predictable.
And then what about like 15-year loans? I hear people saying like, oh, you should never get a 30-year, always get a 15. It's so
only
much
if you
better.
Can afford it. The payment's literally going to be double. I mean, think about that. So, a 15-year loan is amazing, right? But you can also make additional payments on your 30-year loan to get it closer to an 18.
Oh, okay.
Right. So there's strategies, again, financial advisors or, mortgage advisors will give you the little secrets. If you really want, if you're in a mindset or in a financial position to get a 15-year, but you want to just be conservative and get a 30 just in case a couple months out of the year you can't make that double payment or extra. I would say I have a lot of clients that have 15 years, but they're close to retirement. And so they refied when it was super great rates. And then, and they're close to retirement. So they didn't want to get another 30-year loan.
Yeah.
But I would say as a general rule, stick with a 30-year fix. You can always make additional payments.
Yeah, that was kind of my opinion on that, is that, I mean, why get a 15-year loan? Why be stuck with that? You never know what's going to happen. Why don't you just get a 30 and make double payments?
Yep, absolutely.
Yeah.
I mean, if you make just one additional payment a year, so your whole payment, and have them apply it to principal only, I think it takes the 30-year loan to a 26 or something. So right off the bat, just that one additional full payment towards the principal balance makes that much of a difference, in compounding interest. So there's strategies where you can make additional payments and get to that point. So I would just do that. I'm more on the conservative end because I've seen people lose their homes or be late on their payments because maybe they lost their job or they didn't have the reserves they needed. And so I'm just go conservative. You can always go big. You just can't go backwards if you have a 15-year.
Yeah, absolutely. Otherwise you're refinancing it into
Then you're going to refinance and maybe with a higher rate, which would be a bummer.
Yeah, absolutely.
Yeah.
Absolutely. Well, do you have any parting words for the people that are watching this video?
I do. Just do it. Just get pre-approved. It is not going to hurt you. And we make it easy for you. I mean, it's literally, a 5 or 10 minute application. And then you know where you stand. And there's no obligation to use me or to buy. But if you think you want to buy, I would get pre-approved so that you know where you stand.
Yeah, absolutely. I think it's the first step.
Yeah.
And it's really like, you don't know where you are until you know exactly where you are starting from.
Knowledge is power.
Absolutely. That's how I felt. I was like, oh, this sucks. I was like, this isn't what I want at all. Okay, well, what do I need to do to get to where I want to go? That's
right. And that's the magic, right? That's the magic. If you're not ready today, then you know you're on a plan. And maybe it takes you 6 months, maybe it takes you a year, but you know where you need to be. Otherwise, you're just guessing, or you're going with what your cousin's nephew's aunt said, which is not a good plan.
Absolutely. Absolutely. Well, thank you so much for spending time with me today, Stacey.
Thank you so much for having me.
Absolutely. Everybody on this should reach out to Stacy Medinas if you need any loan information or you want to get pre-approved. I will make sure that her information is below.
And I am national, by the way. So we can do loans in almost all states. Hawaii and Alaska definitely are off the table. And I think there's a couple randoms, but majority of the United States we can lend in.
Okay, that's really good to know. So hopefully we see more people on this that are out of the state that get some more.
You never know.
Okay, good. Yeah, absolutely. All right. Well, thank you everybody for watching. Again, my name's Amy Tremaine with Main Street Properties. If you're looking to move to the Sacramento area, I want to make sure that it is a smooth transition for you. All of our contact information is below. Please like, subscribe, and tap that bell so you can see more videos like this.